Again, these are very foundational topics that are critical to your success as a financial manager, as a manager or leader in any organization. So these will be very, very important to your success, and we'll build upon some of these concepts as we move on through other sessions. Some key formulas you need to know are the balance sheet equation or identity: assets equal liabilities plus owner's equity. My accounting teacher way back in the day used to pound on the board, "It's gotta be. It's gotta be." And I'm wondering, what does he mean, it's gotta be? Well, the balance sheet has to balance before you can leave work. We'll go over that a little bit later in more detail. Another key equation is net working capital. And we went over this in session 1 a little bit. Net working capital is current assets minus current liabilities. Current assets on the left side of the balance sheet and current liabilities on the right side of the balance sheet. Both of these are due within 1 year. The income statement identity or income statement equation: revenues minus expenses equals net income, or sales minus cost equals net income. And we'll go into some other names that are kind of loosely tossed around for each of those variables. And finally, and maybe most important, the cash flow identity or free cash flow. Cash flow from assets equal cash flow to creditors plus cash flow to stockholders. We'll show you a couple ways to calculate those equations. The learning objectives, what you want to be able to take away from this session is an understanding of the balance sheet. That's learning objective number 1. What is the balance sheet and what is it used for? When do we prepare the balance sheet in the average organization? And how will it help you as a manager? Second objective, the income statement. What is an income statement? Again, when is it prepared? And how can it be used to your advantage? Third, corporate taxes. What are corporate taxes? What are tax rates on a corporation currently? And are they a financial or a political process? And fourth, cash flow. How to calculate cash flow, free cash flow, and some details on that. So let's move into the balance sheet. First of all, the balance sheet is a one-day snapshot of the company's accounting value, its economic health. Is the company healthy or not? On one side, on the left side, is what the company owns, and on the right side, what the company owes. So it's a measure of ownership and what the company owes. Usually prepared on the last day of the month. Again, it's a one-day snapshot, so we must stress that. Prepared on the last day. So in March, it's going to be prepared on March 31st. In April, April 30th. In May, May 31st. In June, June 30th, and so on. It's a one-day snapshot. Includes assets, liabilities, and owner's equity. And it's got to be. The balance sheet has got to balance before you leave work that day. Assets must equal liabilities plus owner's equity. On the left side, these items are listed in order of decreasing liquidity. So the most liquid items are listed first. Cash is listed first. Accounts receivable, a little bit more difficult to collect, therefore second. Inventory, even more difficult to sell and turn into cash or liquidate quickly. And finally, prepaid expenses or prepaid items and other items. These are part of your total current assets, and these are items that are expected to be turned into cash within 1 year. And you may see slightly different definitions of that, but in the short term. On the right side, you'll see the same thing under in the current category under liabilities. Current liabilities are things that you owe within 1 year, things that must be paid within 1 year, to include accounts payable, notes payable, interest payable, taxes payable, wages payable. And again, some definitions might slightly change that to be sooner than a year, but in general, these authors like to talk about having these items due within 1 year. What's left over is shareholders' equity. So once I take when I subtract these two, I take my current assets minus current liabilities, and I get net working capital. When I take my total assets and subtract my total liabilities, I get what's left over, and that is stockholders' equity. Stockholders are residual owners of the corporation. You might see some items listed in an accounting course under your shareholders or stockholders' equity, like common stock, preferred stock, paid in surplus, paid in capital, and retained earnings. You may see some different terms there also. but in general, they'll be very similar to that. In general, the thing you want to remember about the balance sheet, assets equal liabilities plus owner's equity. And that is a key equation that you must take with you from this course. Never forget it. Assets are listed in order of decreasing liquidity, as I said. So current assets are at the top of the balance sheet, and longer-term assets are at the bottom of the left side of the balance sheet. And these are things that I own on the left side. They're listed in order of decreasing liquidity. And so again, current assets first, longer-term assets second. Total assets are the summation of the two. On the right side, same thing. Items are listed in order of decreasing liquidity. Current liabilities are listed first, and then longer-term liabilities like long-term debt, mortgages payable, things like that, bonds payable are listed under long-term debt, again, in order of decreasing liquidity. Assets equal liabilities plus owner's equity. Again, I can't say that enough. That's one thing you have to remember. Owner's equity, also called shareholder's equity, also called very loosely book value, net book value, or net worth. So you have to understand that all these items mean assets minus liabilities. Again, shareholder's equity, stockholder's equity, owner's equity, net book value, net worth, all mean assets minus liabilities. Again, depending upon the author or the source, you may see any of those terms to mean owner's equity. Net working capital, we said in an earlier session, is a very critical equation that you must remember forever, and that's the difference between current assets and current liabilities. Obviously, I like to have more current assets than current liabilities to be able to pay my bills in prompt fashion every single month. When I look at a balance sheet, I want to put 3 sets of goggles on, as I like to say, when evaluating and analyzing a balance sheet. First, I put on my liquidity goggles when I look at a balance sheet. Then I put on my debt versus equity goggles, and then I put on my market versus book goggles to look at a balance sheet. First of all, what is liquidity? Liquidity is the speed and ease with which I can turn an asset into cash without a loss of value. So if I can quickly turn something into cash, it's very liquid. If it takes a little bit longer, like inventory, it's a little bit less liquid. So ease of conversion without loss of value is liquidity, and liquidity is a good thing. You're less likely to have financial distress if your company is liquid. Same thing at the end of each month. If you have some cash to pay your bills, you're less likely to get into financial distress. Second set of goggles, debt versus equity. I put those goggles on to look at how much debt does a company have. Some companies are immensely burdened with debt, and that's usually a sign of trouble. Right away. Some companies, if you look at their balance sheet in Edgar, in the SEC website, you can see very quickly that these guys are going to have trouble making their debt payments, making their interest payments, and so on, and that can lead to significant financial distress. Same thing on a personal level. If you don't have a lot of liquidity, it can be difficult to pay your debts and even to pay just the interest on that debt, much less the principal. Financial leverage is a measure of your debt. When you hear the word leverage, think of the 4-letter word debt. Too much leverage can be a bad thing. Too much debt, if you buy too big a house, more than you can afford, that can put you into some sort of some financial distress. So be careful with your level of debt that you take on a personal basis and on a business basis. Third, I want to put on my market versus book value goggles. What is the market value of the company? What is the book value? Now, book value generally means historic cost. So when you hear the term book value, think of the words historic cost. We put a lot of our assets on the balance sheet at historic cost, and it's a measure of book value. Unfortunately, it doesn't tell you what it's worth in the market, what it's worth today. If you were to take a particular asset that you have and go outside and try and sell it, or sell it on eBay or another website, you may find that the market is drastically different than book. And truly, there's no relationship between market and book. Market isn't always higher than book. Book isn't always higher than market. These things can vary over time. Here's a good example. Look at a simple thing like a football card here from eTops. The book value was $4.25. And it varies every day after that. It might be worth $3.59. It might be worth $2. It might be worth $60. So the market can vary widely from book. Book is historic cost. Market is what the asset is worth that day when you try to sell it.